I always choose a stock of the day, and I thought we'd do one which has had stellar performer in the recent earnings season, and comes up often here on the call. Aussie Broadband, out of a trading halt this morning after sewing up $114 million institutional placement. The company saying the cash will be used in a bit of M&A, technology development, lining up business and new business and on its fibre networks. Aussie also putting a share purchase plan on the table for existing shareholders, capped at 10 million. Been a good run for them after listing in October. Aussie Broadband up 140%. So how does it stack up against some of the bigger telcos, and whether it's a growth story? Henry, a lot of the experts on the call here criticise companies who have to raise capital when their share prices are at a low. Aussie Broadband taking advantage of its run-in share price. How do you see the raise and the stock?
Interesting one, isn't it? They've had an almighty run, good numbers, beats across the board, rolling out their fibre, doing very, very well. Good ads on TV as well with the guy holding the hose. That always helps. And I suspect it's no real sort of surprise that we've seen the stock price go up as they've increased their marketing. And they come out really well with customer satisfaction. Of course, everyone loves to beat up on Telstra, but Aussie Broadband really is kind of the Aussie that, the little Aussie battler that can. I must admit, I'm surprised about the market reaction to this capital raising. It's a lot of money, it's opportunistic, and they haven't said really what they're going to spend it on. They've talked about acquisitions, they've talked about some that they've been looking at, but not that far advanced. It's a nice big fat war chest, I have to say. But if I was an institution and I'd just taken stock at $4 and the stock's trading at 4.60 and I had a 14% locked in return, I think I'd be looking to unload a bit of that stock. I might do it quietly, but that's a good year. That's not, you're going to have to see the stock accelerate a little bit to the upside to make that one worthwhile. If I was taking the stock at $4, I'd be tempted to knock it out. I've got to say, that's my kind of style. And I also believe that frequently in these capital raisings, at some stage, and I don't know when, at some stage in the future, the stock will come back to the price that they raised the money at. And when it does tend to accelerate a little bit, because those guys that took the stock at $4 looked at knocking it out at 4.60 and locking in the nice little profit, the nice little turn moving on to the next one, will panic a bit if it starts to get that back down to 4.20, 4.10, and that could accelerate it back down to $4. So I'd love to be able to buy it at $4. Lucky shareholders will be able to get it through the SPP at $4, but good luck, that'll be heavily oversubscribed if there's 60 cents in it. So for me at the moment, I think there's a little more downside, and it's opportunistic. The market loves this stock, but it's run really hard, and I think it may have run a little bit too hard in the short term. I tried to buy it for my small cap fund a week or so ago after the results, and fiddled and faddled around and really sort of paid up. But I think at some stage you'll get the chance to buy it at $4 in more size than you'll get in the SPP.
Yeah, okay. Andrew, it has had a good run. People give it great raps because it targets that high-end user, doesn't it, on the internet, and its customer service apparently is sensational.
Yeah, Koshi, the disclaimer, not that I knew you were going to ask this, but I'm actually a customer of Aussie Broadband, so I can sort of speak to that. And yeah, service is first class, not being paid to say that's just true. For us, the service is excellent. I was actually offered shares as a customer in the IPO and faffed about and didn't get onto it, and how silly am I? So I could have got in at much lower. Just looking at the numbers, the PE is around 53 times. Forecast earnings per share growth this year is around 63%. So remember the old PEG ratio, where you're trying to buy it with a PE ratio lower than the percentage EPS growth. So it ticks that box by quite a bit. So I quite like it. I do agree with Henry though that this market has not drawn breath for 220 something days now, so it is absolutely ripe for a pullback. And stocks like this, which have got such a great gain, and it will be one of the first ones that get knocked out. So even though in a valuation sense it makes sense, I would absolutely be looking for that weakness as well. But it is a quality longer termer that you would be absolutely buying on weakness.
Yeah, and the management's pretty smart to actually take advantage of the share price at this level, build a bit of a war chest, even though they try and say we've got plans for it. Even if they don't, to have it in the bank if something comes up is a pretty good advantageous place to be.